Welcome to the Deep Dive. Today we're pulling back the curtain on a part of finance that often feels a bit like a black box.
Quantitative trading.
Right. Specifically, we're diving deep into what goes into creating those actual trading signals, the things quants call alphas, that drive the automated decisions.
That's right. And for this particular deep dive, we've got two really interesting sources. First, it's a rare find, a research paper that actually lays out the explicit formulas.
Formulas.
Yeah, written as computer code for 101 real-life trading alphas, things actually used in production.
Wow, 101 real ones. That sounds like incredible access.
Mhm.
Usually that stuff is super secret.
It really is. And then our second source tackles something absolutely fundamental if you ever want to build strategies based on signals like these.
Which is?
The critical need for your code to run fast. It's a practical case study on exactly how to make that happen.
Okay, so our mission today seems pretty clear then. We're going to try and, peel back the layers on what these quant trading alphas actually look like under the hood.
Yep. Explore some surprising properties they revealed when they were analyzed in the paper.
And then understand that key technical hurdle and, crucially, its solution that's essential for anyone wanting to implement or even just test these kinds of strategies effectively.
Think of it as getting a bit of a shortcut to understanding a really fascinating, pretty high-tech corner of the market.
All right, let's jump in.
So we start with that first source, the paper. It's called 101 Formulaic Trading Alphas by Zura Kakushadze.
Okay.
Now, the author defines alpha here maybe a little differently than, say, the strict academic textbook definition.
How so?
For this paper, it's basically a combination of mathematical expressions and, well, computer code designed to predict future price movements of financial instruments.
So it's the signal, the
Right.
thing you use to decide when and what to trade.
Precisely. And the paper immediately highlights these two major forces shaping modern quant trading. They're almost, pushing in opposite directions sometimes. On one side, the signals themselves, the alphas, they're getting fainter, more temporary, harder to find. So you need increasingly sophisticated techniques to actually dig them out.
Right, the low-hanging fruit is gone, so you need better tools.
Exactly. The signals are weaker, demanding more subtle detection methods. But then, on the other side, technological power is just exploding.
Moore's Law and all that.
Pretty much. This lets firms automate the search and processing for a massive number of alphas. We're not talking dozens or hundreds anymore.
How many are we talking?
The potential is, well, millions, maybe even billions of potential individual signals.
Millions or billions. Okay, so if you've got that many potential signals, and they're all pretty faint, you can't possibly trade each one by itself, right?
No way.
The paper talks about combining many of these individual weaker alphas into one big mega alpha. Why do firms do that? What's the advantage?
Well, there are several big reasons. First, combining them allows for automatic internal crossing of trades within the firm.
Ah, so matching buys and sells internally.
Right. Which dramatically cuts down on external trading costs like commissions and market impact. Second, it provides crucial portfolio diversification.
Hedging your bets, basically.
Kind of.
Yeah.
Hedging against the risk that any single alpha suddenly stops working, which they often do. And importantly, it helps manage the inherent data challenge,
You mean
the
Right.
too many variables, too few observations problem. You face that when trying to model and trade based on so many distinct signals. Combining helps simplify.
Got it. And the really unique thing about this paper, the reason it caught our eye, is that instead of just talking about alphas conceptually,
It gives you the code.
it actually provides the explicit formulas, the code snippets, for 101 alphas that were apparently used in live trading.
Yeah, it really does give you that rare peek behind the curtain into how this stuff is actually built. It's a level of transparency you almost never see.
So what are these 101 alphas based on? What kind of data?
Mostly price volume data. So things like
Mhm.
daily returns, open close, high-low prices, trading volume, VWAP, volume weighted average price.
Standard market data, then.
Mostly. But some do mix in fundamental inputs like market capitalization. And they use industry classifications, GICS, BICS, things like that, for what's called industry neutralization.
Industry neutralization, what's that about?
It means making the signal less about whether an entire sector like tech or energy is going up or down, and more about a stock's relative movement within its own industry, trying to isolate the stock-specific effect.
Okay, that makes sense. And are these like long-term investment signals? Buy and hold.
Not really, no. The analysis in the paper, which used data from early 2010 to the end of 2013, shows the average holding period for these 101 alphas is pretty short term.
How short?
It ranges approximately from just zero point 0.6 days up to about 6.4 days, so definitely not long-term hold.
Right, more like swing trading or even shorter. Okay, so based on that data set, what did the paper find out about these alphas? Any key properties?
Yeah, some really interesting empirical insights. One big one that jumped out is the average pairwise correlation between the different alphas.
How much do they move together?
Exactly. And it turns out it's quite low. The mean correlation was only 15.9%, and the median was even lower at 14.3%.
Which, going back to the mega alpha idea, is exactly what you want, right?
Precisely. Low correlation means they're not all doing the same thing at the same time, so mixing them together helps smooth out volatility and really improves diversification.
Okay, what else?
Another finding was a strong empirical link between the average daily return an alpha generated and its daily return volatility, how much its value bounces around.
So more return means more bumps.
Generally, yeah. The source presents this as a direct empirical confirmation of a specific scaling relationship. It shows average return, let's call it eta, is strongly correlated with volatility, sigma, following something like eta is proportional to sigma raised to the power of epsilon.
Epsilon.
Yeah, just a constant. And they measured epsilon empirically at approximately 0.76 for this set of alphas. So it's a quantifiable link between the signal's typical payoff and how choppy that payoff tends to be.
Interesting. Okay, low correlation returns linked to volatility.
Right.
What else stood out?
Right, here's where it gets really interesting. And frankly, a bit counterintuitive, maybe.
Uh-oh.
The paper makes this crucial, surprising statement. Based on their analysis of these 101 alphas, the returns have no significant dependence on turnover.
Wait, on turnover, like how often you trade based on the signal.
Exactly, yes. They report this directly. And they note it actually confirms an earlier result they'd found through more indirect means.
Hold on. So the profitability of these signals in this data set didn't seem statistically tied to how frequently they made you buy or sell.
That's what the analysis showed over this period, yes.
That feels odd. You'd think higher turnover would mean higher trading costs, which would surely impact the net return.
It does feel odd, I agree. And the paper clarifies this a bit further. It also reports that turnover itself, specifically the logarithm of turnover, had poor explanatory power for the pairwise correlations between the alphas in their analysis.
Okay, so turnover didn't explain why some alphas were correlated with others.
Right. Now they're careful to say this doesn't mean turnover is useless in all aspects of risk modeling. Maybe it contributes to specific risk in a factor model, for instance. But in this specific test, looking at how these 101 alphas related to each other or how their individual returns behaved, turnover just wasn't a statistically significant factor they found. It's a pretty striking empirical observation from this particular data set and time period.
Wow. Okay, that is surprising. Fascinating stuff. Did the paper categorize these alphas at all? Like, what kind of strategies are they?
Yeah, broadly speaking, they fall into two main camps. Mean reversion or momentum, though some complex ones probably blend elements.
Can you give simple examples? Like, what would a basic mean reversion one look like?
Sure. A really simple one might be something like the negative log of today's open price divided by yesterday's close price. So held till min, open previous close.
Okay, how does that work?
Well, if the stock opened much higher today than it closed yesterday, a big positive gap up the term inside the log is greater than 1, the log is positive, and the whole signal is negative.
Suggesting you should short it.
Right, anticipating that the gap might close, that the price might revert back down, mean reversion.
In a simple momentum one.
A basic example could be LNT, yesterday's close, yesterday's open.
So based on yesterday's move.
Yeah. If the stock had a strong positive move yesterday, meaning the close was significantly higher than the open, the term inside the log is greater than 1, the log is positive, and the signal is positive.
Suggesting you go long today.
Exactly.
Right.
Expecting that momentum from yesterday to continue into today. They also use this concept of delay in the paper.
Delay.
Yeah, delay 0 means the alpha uses data that's available right at the very start of today's trading, like today's open price, for a decision made today.
Okay.
Delay 1 means it uses data only from the previous trading day, like yesterday's close, to generate the signal for trading today.
Got it. So it depends on when the input data is known relative to the trade.
Right. They give alpha hashtag 42 as an example of a delay 0 mean reversion type, and alpha hashtag 101 as a delay 1 momentum type.
And if you actually look in the Appendix A of the paper where the formulas are, they're not simple arithmetic, are they?
Oh, definitely not. They're pretty intricate code snippets. You see them using specialized functions and operators that you'd find in quantitative programming libraries.
Like what?
Things like rank, delay, which we mentioned, correlation, srank, in neutralize.
Whoa, okay. What do those mean quickly?
Well, rank usually means comparing a stock's value for some metric against all other stocks in the universe at that specific point in time. It's cross-sectional.
Okay.
Strength is different. That's typically comparing a stock's value for a metric against its own historical values over some time window, time series ranking.
Ah, relative to itself versus relative to others.
Exactly. Correlation here is often a time series correlation, like calculating how correlated two data series, like return and volume, have been over the last, say, 20 days.
And in neutral.
That's the industry neutralization we talked about, removing the average effect of the stock's industry group to isolate the stock-specific signal. These are complex data transformations, not just simple math.
It really highlights the level of sophistication involved. It's not just looking at a chart.
Not at all.
And, in a slightly unexpected but kind of poignant touch, the author includes a poem at the end of this very technical paper, Mikhail Lermontov's The Sale.
Right, I saw that.
The final lines sort of capture this restless spirit. Maybe it resonates with the constant search in quant finance. But wishing storms the sail seems, as if in storms is peace it deems.
A little bit of philosophy mixed in with the formulas. It's quite memorable.
Yeah. Okay, so we've got a really valuable glimpse into what these real-life alphas look like. Complex, short-term signals, mostly price-volume based, with those interesting, maybe surprising, empirical properties like low correlation and returns potentially unrelated to turnover in this study.
A solid foundation.
But, all right, you have the formula, maybe even the code snippet from the paper.
Yeah.
How do you actually turn that into a trading strategy and test if it would have made money historically? Or run it live?
Yeah, that's the crucial next step. That process requires building and running code, and that's exactly where our second source becomes essential.
Right, moving from the alpha idea to the how you actually do it.
Exactly. The second source is a really practical case study. It's called Vectorize Me by David Bird. And it zeroes in on something absolutely critical for any kind of quant work: computational efficiency, speed.
Okay, Vectorize Me. What's the fundamental problem it's trying to solve? Why is speed so important here?
Well, the core issue is this. When you first start coding quantitative strategies, the intuitive way is often using traditional iterative methods.
Like writing for loops.
Exactly. Writing loops to go through each day, then maybe another loop for each stock, then doing calculations step by step inside those loops.
Seems logical.
It seems logical, but it becomes incredibly, sometimes cripplingly slow, especially with the amount of data and the number of signals involved in modern quant trading.
How slow are we talking in the case studies example? Did they quantify it?
Oh, yeah. The author built a strategy based on what he called a basket indicator. It combined a few common technical indicators: price SMA ratio, Bollinger Bands percentage, and RSI.
Okay.
And he tested this on 7 years of daily data for just 7 stocks, which is, a pretty small data set for real-world quant work.
Tiny, almost.
Right. And that initial version, coded iteratively with nested loops, sometimes triple nested loops for the calculations, took over 5 minutes to run.
5 minutes. For just 7 stocks and 7 years of daily data. Ouch.
Yeah. Painful is the right word.
Yeah.
And you can imagine, right, trying to test that across hundreds or thousands of stocks, or using higher frequency data like minute bars, or just trying to optimize the parameters by running it many times.
You'd be waiting forever. It would be completely impractical.
Precisely. As the author emphasizes, that level of slowness is basically a complete non-starter for any serious quantitative research or trading. You can't explore enough ideas, you can't backtest efficiently, you certainly can't run something like that live.
So what's the solution?
Yeah,
The case study is called Vectorize Me. So I'm guessing vectorization.
you got it. The technique is vectorization. And in Python, this primarily means using libraries designed for highly efficient array operations, like NumPy and Pandas.
Okay, what's the core idea of vectorization? How does it speed things up so much?
The basic idea is simple but really powerful. Instead of telling the computer, okay, take this one number, do this calculation now, take the next number, do the same calculation in a loop.
Which is what the iterative code does.
Right. Instead, you tell it, okay, here's an entire array or column of numbers. Do this calculation on all of them at once.
Performing the operation on the whole data set simultaneously.
Essentially, yes. You let the underlying libraries, which are often written in faster languages like C or Fortran and highly optimized, handle the looping and calculations at a much lower level. It's way, way faster than doing it step by step in Python itself.
So the case study walks through converting that slow 5-minute code into vectorized code. What were some of the key techniques or maybe aha moments in that process?
Well, a big part was just replacing those nested loops used for the indicator calculations, things like calculating the simple moving average, SMA, or the standard deviation for Bollinger Bands, or the components of RSI.
Oh,
By using the vectorized equivalents that are already built into libraries like pandas and NumPy, there are functions that calculate sums, means, standard deviations, differences, correlations, all directly on entire columns or arrays at once.
so using the library's built-in tools instead of reinventing the wheel with loops.
Exactly. They also had to handle potential issues like division by zero.
Yeah, that can happen in financial calculations, like with RSI sometimes.
Right. The case study notes that NumPy handles this pretty gracefully. It often produces an inf value for infinity, where division by zero occurs,
Which isn't ideal, but
but it doesn't crash the calculation. And then, after the main vectorized calculation is done, you can easily find all those inf values and clean them up, or maybe replace them with zero or nan or whatever is appropriate for the strategy. It's much more efficient than checking for zero in every single step of a loop.
okay, that makes sense for the indicator calculations. But here's a question. How do you vectorize the actual strategy logic? You know, the part where you decide, okay, based on these indicator values, should I buy, sell, or hold? That seems harder to do without loops.
Ah, yes. This was a really crucial aha moment described in the study. It requires what the author calls indirect thinking.
Indirect thinking.
Yeah. Instead of trying to calculate the buy or sell orders directly, step by step in time.
Which seems like the natural way.
It does. But the vectorized approach is different. First, you calculate the desired target holdings for every stock across all the days in your data set, all at once using vectorized operations.
Target holdings, you mean like, I want to be long 100 shares of this stock today, or short 50 shares, or flat 0 shares.
Exactly that. What position you ideally want to have at the end of each day, based on your signal. You calculate this desired state for the entire matrix of stocks and time periods.
Okay, so you have this big grid showing your ideal position everywhere. How does that give you the trades?
This is the clever part. Once you have that complete matrix of target holdings, the actual daily orders you need to place are simply the daily difference between the target holding today and the target holding from yesterday.
Oh, I see. So if your target holding yesterday was 0 shares and today it's 100 shares, the difference is plus 100, meaning you need to place a buy order for 100 shares.
Precisely. If the target goes from 100 to 50, the difference is negative 50, so you place a sell order for 50 shares. You can calculate these differences across the entire matrix using a simple vectorized diff operation.
Wow, okay. That completely changes how you structure the problem. You calculate the desired state first, then the actions needed to get there. That is indirect, but it makes the whole thing vectorizable.
Exactly. That shift in perspective is really key to vectorizing the execution logic itself. The case study also mentioned handling things like missing data, NANs, efficiently by forward filling the target holdings array and even optimizing the final step of writing the output file by minimizing any remaining loops.
Okay, so they applied all these vectorization techniques using library functions, handling edge cases, the indirect thinking for orders. What was the final result? How fast was the code after vectorization?
The comparison was, well, astounding. Remember, the initial iterative code took 5 minutes and 24 seconds?
Yeah, for that tiny data set.
The final vectorized code, performing the exact same calculations and logic, finished in just 0.440 seconds.
0.4 seconds, under half a second.
Yeah.
From over 5 minutes down to less than half a second.
It's
Roughly 1,000 times faster.
Yeah, a dramatic 1,000-fold improvement for the exact same task, just by coding it differently using vectorization.
That's incredible. It really powerfully drives home the point, doesn't it? Vectorization isn't just like a nice-to-have optimization in quant finance.
No, it's a fundamental necessity. It's often the difference between being able to test an idea and not being able to test it at all.
And that's why understanding and really mastering techniques like vectorization is pretty much non-negotiable. if you're serious about getting into quantitative trading or research, right?
Absolutely. Being able to test hundreds or thousands of strategy variations or different parameter settings in minutes instead of days, or being able to process the vast quantities of data available today, that's what enables the exploration needed.
Especially if you want to implement those mega alphas we talked about earlier, combining potentially millions of signals, you need the computational horsepower.
You absolutely do. It's the difference between an idea being practically testable and it being computationally impossible. It really is about coding smarter, not harder.
Okay, so let's recap this deep dive then. We've pulled back the curtain quite a bit on the often secretive world of quantitative trading alphas. Thanks to that unique first source, we got to see the actual code for 100-to-1 real signals.
Right. We saw they're complex, generally short-term, often based on price and volume data.
Yeah, they exhibit some really interesting empirical properties like that low correlation between them, which is good for diversification, and maybe most surprisingly, the finding in that study that their returns weren't significantly tied to turnover.
A very intriguing result. And then from the Vectorize Me case study, we learned that turning these kinds of alpha ideas into practical, testable strategies absolutely demands a focus on computational efficiency.
Especially vectorization. Transforming minutes of calculation into mere seconds isn't just convenient, it's vital for handling the sheer volume and complexity of signals in modern quantitative markets.
That synergy is key. The ability to generate complex signals and the ability to process and test them incredibly fast.
Right. So building on all that, here's a final provocative thought for you to consider.
Yeah.
Given that you can potentially generate and rapidly test millions, maybe billions, of alpha signals, and given that you can make the backtesting code run thousands of times faster through vectorization, and if that empirical finding holds true more broadly, that alpha returns aren't significantly dependent on turnover.
Okay.
What does that really tell us about where the primary challenges lie in actually making money from quantitative trading in the real world? Does it imply that maybe the raw signal's predictive power, separate from its turnover, is paramount? Or does it suggest that the really hard parts lie somewhere else entirely, maybe in minimizing those trading costs despite the turnover, or in ultra-sophisticated portfolio construction, or in the microscopic details of trade execution? If turnover isn't the main driver of returns itself, what other factors, beyond just the core alpha formula, become the make-or-break elements for success?